Historically, only about 10% of the stock market was comprised of retail trading. Joe, how has that changed over time?
Sure. Thanks, Sonali, for having me. Retail investors have been growing as a more significant part of the market for a number of years, and self-directed individual investors and a lot of the empowerment that's happened has been a trend for a while. But we certainly saw another few step functions over the last few months. As you said, in 2019, retail, by our estimations, and because we handle 40% of the retail volume, we have a pretty good sense of how much retail comprises of the market, was about 10%. But towards the end of last year, with the zero commission changes that started getting introduced to the market, we did see that increase to about 15%. And then if you fast forward to this year, with a lot of the COVID-related volatility that we saw, we've definitely seen that percentage increase more towards the 20%, and even on peak days, closer to 25% of the market. So some of that is obviously triggered by structural changes like zero commission. Some of that triggered by some of the situations we have. So how much remains is still to be seen, but certainly we continue to see retail investors becoming a more significant liquidity source in the marketplace.
Does that sustain? And what are they actually buying? Is it equity? Is it options? What are you seeing?
Yeah, I mean, it's really been across the board. Equities is the part people mostly speak about, but we're also the largest options liquidity provider to retail, and so we've seen a very significant increase in options activity from the retail brokers. I think some of that is a reflection of the sophistication level of investors. Some of that is reflective of the more sophisticated tools that have been introduced to investors. So it's just a furtherance, I think, of that empowerment angle.
Joe, it's Guy in London. You talked a moment ago about whether or not we'll see some of this activity being sustained. Is the kind of the lockdown trader still engaged with the market, or have they gone elsewhere?
Hey, Guy. I think it's still a little bit of both. We definitely continue to see high levels of engagement by retail. I think we'll need a longer period of time to really make a determination of how much of that is driven by current market conditions versus some of the more structural changes. But we haven't really seen a significant decline at this point.
Joe, there's a perception in the market that the retail traders are really the dumb money, chasing the smart money. Do you think that that's antiquated now that so much of the market is retail?
Yeah, I always think that's been, a little bit of a misnomer. I mean, certainly retail investors have a different investment horizon and a different profile to their orders, but ultimately, the market is going to price in all the information that it has at that point in time. Retail is clearly a significant force, but they're not going to be the ones that are solely able to drive valuation or market levels. So I do think that retail continues to get more and more sophisticated. I think they continue to get more and more educated. I think they're one component to a broad amount of the market. And look, I think a lot of what drives their activity is the benefits that they get from participating in the marketplace.
Right.
A lot of why participants like us get retail orders is because of the significant amounts of price improvements that are given. In the first half of this year, we gave about $670 million of price improvement to retail investors, and that works out to about $7.50 a ticket. That's real money that we used to say used to more than offset the cost of the commission. Now, with commissions largely driving to zero, that's money that goes literally into the pockets of investors. It helps them save. It funds their retirement. And it's a really attractive component of the market that drives a lot of that activity.
Well, speaking of the economics here, with so many brokers driving these prices down to zero, what type of money is there to be made in this market anymore?
Look, I think a lot of, from our standpoint, we are a very large liquidity provider across a very wide range of assets. And so we, in the equities side of the market, we interact with about 21% of average daily trading volume. The retail part of our business fits very well with the overall model that we have, and then we've been able to broaden that to other asset classes, whether it's options like we spoke about earlier, or FX, or our treasury business. We've been able to partner with a lot of our clients and leverage our model and broaden out the benefits that we bring to the marketplace. At the same time, if you're asking from the broker standpoint, we do continue to see some consolidation. We spoke about options earlier. We continue to see broadening to other asset classes. So I think that people continue to find innovative ways to both empower investors and to bring innovative products to the market.
Joe, you make money, though, as spreads widen out and when volume goes up. Now, we definitely saw both of those two things happen a couple of months back. It's tightened up a little bit since then. But we're looking at markets and we're trying to work out where the next catalyst comes from. And I'm wondering whether you guys are anticipating that we do see another bout of volatility, that we do see spreads widening out again and volume picking up. Do you think we're done with the current situation, or do you think we go back to that kind of choppy market that we saw, as I say, a couple of months ago?
Yeah, I mean, only time will tell, and it's the right question that I think a lot of people are wondering about. If you go back to my earlier comment and the theory around markets and pricing in current information and looking at where valuation is, clearly the markets have been normalizing and taking a bit of a view that the outlook is positive. But that said, I do think that to the extent any new information comes out, whether positive or negative, or anything that is unknown at this point gets incorporated, then certainly we could see heightened volatility as the market digests whatever new information comes out. So at this point, I think we're just waiting to see how things evolve as a marketplace.
Joe, so far the volatility, when you look over the year, has really benefited the market to the upside. But when things get choppier towards the downside, how is that going to will it dramatically affect how retail investors see this market?
Yeah, it's an interesting question. Our role is really making sure that clients and retail investors in particular are able to buy and sell when they want. So we, as a market maker, are there to fill the other side of their orders. We buy when they want to sell, and we sell when they want to buy. And our role is making sure that they have a very smooth experience. And, it's really impressive when you look back at some of the volume levels that we saw earlier this year. I think in 2019, the highest volume level we saw was around 2 billion shares, and our average in March alone was 3.3 billion shares. And I think a lot of people take for granted how well the markets work and how smoothly they function in times when not only are markets going up, but when they're going down. And so a lot of our focus and our value add in the marketplace as an electronic liquidity provider is making sure that whatever direction markets go, we are there and filling our role as a liquidity provider and making sure investors have as smooth an experience as possible.
Using your lens into the option world right now, can you give me any sense of how retail in particular is looking at some of the catalysts we have coming up, whether it's earnings season, whether it's the U.S. presidential election, and the professional options market? We kind of see some movement there. Can you tell me anything about that?
We don't really take a view based on where clients are going, but we do see expansion of their participation in different option instruments. Historically, it's been more of a single leg focus on products. We've seen them get more into index products. We've seen them expand into more complex order types. So again, I think the impressive part of the marketplace is that whether it's from the brokers, whether it's from market makers like us, the range of tools that have been made available to retail investors are, impressive and give them a very broad number of ways to get exposure to the market.
Joe, we saw a Chinese IPO today that went up over 900% on the STAR market. Now, I'm not suggesting we're going to see anything like that over in the United States or elsewhere, but I'm wondering what's in the pipeline right now. You've got some pretty good visibility here. Do you think it's a good time to bring stocks to market, and what could we see throughout the rest of this year?
Yeah, it's something that I think we and a lot of people are paying a lot of attention to, and we have a lot of exposure to the IPO market through we operate the largest designated market maker on the floor of the New York Stock Exchange. And, if you step back, the IPO market has been interesting over the last few years. There's been two interesting ways that have been developed for companies to go public aside from just a straight IPO. We've certainly seen sustained demand for interesting companies. We handled the IPO for Lemonade last week, and that one was met with very, very strong demand. But the two things that have also come to market is we saw the introduction of direct listings, and Sonali and I have spoken about that. There's been very good reception with companies like Spotify and Slack using that as a mechanism to go public in a market-driven way. And then more recently, we've seen a really strong increase in the amount of SPAC issuance, and SPACs stand for special purpose acquisition companies. They're basically companies that go public with the intent of taking a private company public. And that's been about 40% of the issuance this year. The more notable one that we saw last year was a company called Social Capital used the SPAC vehicle to take Virgin Galactic public. More recently, you may have seen Pershing Square filed for a SPAC that it's called Pershing Square Tontine Holdings, and it's a $3 billion issuance that could go up to $6 billion. And so that should be coming to market soon. We're going to be helping with that. And that has the stated intent of taking some large retail-oriented unicorn-type company public through its mechanism. So really interesting ways that we've seen the market evolve. You've seen headlines around interesting companies like Quicken Loans and Palantir exploring the public market. So I think it'll be interesting. Companies are definitely looking to access the IPO market in the coming months.